What if I told you that you could read the market's mind? That just by looking at a stock's price, you could know exactly what it's expected to do? Well, today, we're going to uncover that hidden forecast, and I promise it's going to completely change the way you look at investing.
No, really, think about that. Every stock price you see on your screen, it's not just a random number. It's a story. It's an entire forecast of the future that's already baked right in. So the real question becomes, what exactly is that forecast? And maybe more importantly, is it even realistic?
Okay, so to really get why this is such a game changer, we have to look at the old way of doing things. You know, the traditional method for valuing a stock, which, let's be honest, is basically just a sophisticated guessing game.
Right, you've probably heard of the standard discounted cash flow model, or DCF. The idea is pretty simple on the surface. You try to predict all the cash a company's going to make in the future, and then you figure out what all that future cash is worth in today's money. Boom, you get what people call a fair value for the stock. But, and this is a big but, here's the problem. The whole thing is built on a mountain of assumptions. You have to guess future growth rates. You have to guess what the company will be worth 10 years from now. You have to guess the right discount rate. I mean, what happens if your guesses are even a little bit off? The whole valuation can be completely wrong. It's a model built on, well, a crystal ball. And this is where we flip the whole thing on its head. Instead of us guessing the growth to try and find the right price, we're going to take the price we already have and use it to figure out what the market is already guessing about the growth. That's the big idea here.
So what's the alternative to all this, well, guesswork? Simple. We flip that old equation upside down and let the market do all the heavy lifting for us.
Yeah, the best way to think about this is like solving a math problem backwards. Normally, you plug in a bunch of numbers to get an answer, right? Here, we're starting with the answer, the stock price, and we're working our way back to figure out what numbers the market must have plugged in to get there. And honestly, this is the big aha moment. You stop trying to force your own predictions onto the world. Instead, you just listen. You let the price itself tell you what millions of investors all around the globe are collectively thinking about this company's future. So here it is, the key definition. Reverse DCF is a tool that takes today's stock price as the starting point and works backward to calculate the future growth rate the market is expecting. It literally answers the question, okay, for this stock to be worth this much today, how fast does the company actually need to grow?
Okay, so we've got the what. Now let's get into the why this matters. Because this is where the tool goes from being interesting to being incredibly powerful. It helps us slice right through the market hype and compare it to cold, hard reality.
See, this is the crucial part. Once you know what growth rate the market expects, you're suddenly in the driver's seat. You get to be the judge. You can look at that number and ask, is that even realistic? Is the market being way too optimistic here? Or just maybe, is everyone being way too pessimistic?
All right, let's walk through a classic example, an overhyped stock. You know the kind. This is where a reverse DCF is your best friend. It's the ultimate reality check.
So, imagine we run the numbers on a popular tech stock, and the model spits out 25%. Now that's the implied annual growth rate. That means the market expects this company to grow by 25%, not just next year, but every single year for the next decade. Just think about that for a second. That is an incredibly high bar to clear. And this is where the picture gets crystal clear. The market is pricing in a whopping 25% growth year after year. But then you look at the company's actual history, and you see they've only ever managed to grow at, say, 8%. That huge gap between the market's fantasy and the company's reality? That's a massive red flag. It's screaming that the stock is probably overpriced.
But hey, it's not all about spotting overinflated bubbles. This same exact tool can help you do the opposite. Find those companies that the market is either unfairly beating down or just completely ignoring.
Okay, so let's flip the script. Imagine we find another company and its price implies a growth rate of just 3 to 5%. That's a pretty low bar. The market is basically saying, yeah, this company's best days are behind it. It's just going to tread water from here on out.
But what if you've done your homework? What if you know something the market is missing? What if you see they're actually growing at 15%? Maybe they're about to launch some game-changing new tech. That is your edge. When the market expects nothing, but you see something big happening, you might have just stumbled upon a hidden gem.
You know, at the end of the day, this isn't just about plugging numbers into a calculator. It's about a fundamental shift in your mindset. It's about moving from being a speculator to becoming a true strategist.
And that brings us to the most important question of all.
See, most people look at a stock and ask, hey, is this thing going to go up? It's a simple question. But the strategist asks something much, much smarter. They ask, can this company actually beat the expectations that are already baked into its price?
The moment you start asking that question, everything changes. Seriously, you stop chasing whatever's hot, you stop getting swept up in the latest hype. Instead, you start investing based on a clear strategic calculation. Can this company realistically do better than what the market already thinks it can do?
So you're probably wondering, okay, this sounds great, but how do I actually do it? Well, the good news is you don't need to be a Wall Street quant. The process is actually pretty straightforward.
It really just boils down to 3 steps. Step 1, you start with the current stock price. That's your anchor to reality. Step 2, you find a reverse DCF calculator online. There are plenty of free ones out there, and you plug in a few basic numbers. And finally, step 3, the calculator does the magic. It works backward and gives you that one crucial number, the growth rate the market is expecting. And that's the number you take and compare against what you think is actually possible.
And you know what? In our next explainer, we're going to do exactly that. We'll grab a real company, walk through the whole process, and break down what the market is pricing in step by step.
So I want to leave you with this. The next time you look at a stock, don't just ask the simple question, will it go up? Ask the strategist question. Ask, what is this company already priced to do? Because understanding that, well, that changes everything.